So today we're going to look at the second lecture in financial accounting. And if you did not watch the first one, please go there and watch it so that you can get updated to what we are to where we are now. Okay, so we are starting Unit 2, and in Unit 2, we are looking at bookkeeping. Now, what is bookkeeping? Okay, we are saying this is a part of accounting which involves the recording of day to day transactions. Now, we are saying historically, until 100 years ago, all counting data was kept by being recorded manually, which is in books, okay, papers, and other forms of writing. Okay, now this was in form of bookkeeping. Okay, bookkeeping. Now nowadays only small organizations use this kind of bookkeeping where they just write in books, but many of the organizations, bigger organizations, use electronic systems. Okay, the data is stored electronically, and it is also recorded, okay, now using computers and other devices, phones and other devices that are able to store and keep as well as output information. Okay, now bookkeeping by definition, I say, is the process of recording data relating to accounting transactions in the accounting books. Okay, now that is the definition. Now we are saying this information is further used by certain people that have got interest, or we are saying stakes to the business. Now, who are these users of the accounting information? Now, possibly we are saying users of accounting information include one, managers. Okay, now managers have a need for the business information through the bookkeeping, in the sense that they are given a day-to-day decision, what directions, meaning that these people as managers, as they are making decisions for every day or for the running of the business, they need past information, okay, for them to be able to take decisions that will affect the future of the business. Now they need to know how well things are progressing financially, about the financial status of the business. Okay, now that's the role of the manager. Okay, so first users of information is what the managers. The second users, we are saying the owners of the business. Okay, the owners of the business. Now, these people, they want to be able to see whether or not the business is what? Profitable. Okay. Now, you as the starter of the business, you want to see if that venture you are starting is going is doing well or not. You may not be there to run it. There may be a manager, but you want to know that that venture, you'll be able to track the progress to see how it is adding to the value of your income. Okay, in addition, you as a manager, you would want to know, or you as the owner of the business, you would want to know what the financial resources of the businesses are. Okay, now the second user, so the second users, owners of the business. Then the third, prospective buyers. Now when the owner wants to sell a business, the buyer would want to see such information. Okay, let's say tomorrow you want to sell a company. Okay, a person would want to see the information to that company. So therefore it is very important to keep records, because those records will be needed by what? A prospective buyer, as the third user of information. The fourth, the bank. Now, if the owner wants to borrow money for use in the business, then the bank will need what? Will need such information. Now, you see, information is very, very important for the business, because you need support from all these people, and all these people want to know, the vitality of the information that, or your company. What benefit does your company have? Okay, for them to be able to sponsor you, or to be able to engage with you, or to be able to give you projects, or to be able to provide the information that you need as a business. Third is the tax inspectors. Okay, now tax inspectors, they needed to be able to calculate the taxes payable. Okay, so the other users of information were saying the prospective partners. Now, if you want to partner with anyone would want to partner with you, they want to share the ownership with someone else, then they would be partners in that business, in that they need information. Okay, now these partners would be investors, okay, either existing or potential ones. Okay, now they want to know whether or not invest their money in the business that is profitable, or the business is regaining conscious to be able, is the business is regaining stance. Okay, so now the partners would be able to know. Now there are many other users of accounting information apart from prospective partners, apart from tax inspectors, apart from managers, apart from business owners. There are so many users of accounting information now, which among others may include suppliers, employees, okay, and many others. Now, for example, one obvious fact is that without properly recorded accounting data, as a business would have many difficulties providing the information these various users, okay, may require. Okay, now these people are stakeholders. Okay, every business, so long it is able to transact, it is able to communicate with the community, the environment, it has got what stakeholders. Okay, and these stakeholders will require information about the well-being and the welfare of the business. And among the people that will need the information is the government at large. Okay, the government may need information of the business. Now, however, the information produced by accounting needs to be a compromise. So many different groups of stakeholders make it possible to produce accounting information at a reasonable cost in a form that suits them all. Okay, now most of the organizations see it as a what, as a compromise. So we have got these agents that would actually manufacture the information for you, for the people to be able to see. Now, as a result, accounting focuses on producing information for owners. Now, you as an accountant, or you as a financial accountant, you are looking at producing this information for the owners, or for the stakeholders of the business. Now, the other stakeholder groups often find the accounting information provided fails to tell them what they really want to know. However, if organizations made the efforts to satisfy the information needs of all stakeholders, accounting would be very, very, very costly exercise indeed. Okay, now, so we are seeing how vital or how important accounting is, okay, in providing this information. Now let's look at accounting equation. What is this accounting equation? What are we talking about? Okay, now by adding the accounting equation, we are saying by adding up what the accounting records say belongs to a business, and deducting what they say the business owes, you can identify what a business is worth according to those accounting records. Now, accounting equation, it is actually an equation. It is one of the important equations in financial accounting, because it will actually tell you, or it will bring out what the company owns and what the company owns. So here we are talking about the capital. Okay, we are talking about the capital of the business, amount of money that the business has, and the amount of cash that the business is paying other stakeholders, the banks and other things. Now let's see how it goes. Now, the whole of financial accounting is based upon this very simple idea. Okay, now the whole financial accounting is based on this whole idea known as accounting equation. Okay, now if a business is to be set up, start trading, okay, set up and start trading, it will need resources, right? Okay, you and I understand that you need resources for you to embark on a business. Now let's give an assumption. Okay, let's assume that the first, okay, let's assume first that it is the owner of the business who has supplied all of the what, resources. Okay, meaning you've provided all the resources that the business needs. Now this can be shown as below. So we've got resources supplied by the owner, right? Okay, then which is equated to resources in the business. Okay, so meaning that your financial capacity is equal to the financial capacity of the business. Okay, so if we are at that level, we understand, then we are moving. Now, in accounting, special terms are used to describe many things. Now, the amount of the resources supplied by the owner is called the capital. Now, that what we are looking at here, we are looking at the resource supplied by the owner. Now, that is what we call capital. Okay, that's what we call capital. Now, the actual resources that are then in the business are called the assets. Okay, now that resources now they're separated now from the capital. Now that the owner supplies, then it is what we call the assets. Okay, now on the other side, resources in the business are going to be called the assets. Okay, so let's get it clear. Resources supplied by the owner, capital; resources in the business, assets. Okay, now this means that when the owner has supplied all of the resources, the accounting equation can be what? Can be shown as capital and assets, just like what we were saying. Okay, so the resources supplied, then the resources in the business, so capital and assets. Okay, now however, people other than the owners have supplied some of the assets at some point, okay, in certain extents. Okay, now liabilities is the name given to the amount owing to these people for these assets. Now, like we have saying, other people have supplied assets, okay, to the business. Okay, now this is what we call liability, because a business has to pay back if it's a loan, if it's a bank that has come on board and provided assets, for instance a mortgage and other things. That is other, other people have come on board and assisted the business. Okay, now later we're going to look at the issue of later we're going to look at the issue of the we're going to look at the issue of shareholders. Okay, so these people provide assistance. Now, so we are talking about capital, assets. Now, these assets minus liability. Now, your actual asset, the actual value of the asset is minus what other people have given you. So our equation is going to be capital is equals to assets minus liability. Okay, so liability, you are looking at the amount that your business owes other people. Okay, now at some point, like we've said, people come on board and assist you with the assets of the business. Now, as they are assisting you, we are the amount we are paying it back. They are not giving unless it's a grant. Okay, we're going to look at type of assistance, but for now, unless it's a grant, but for now we are assuming that it is not a grant. They are giving us a loan or something that will be able to pay in a concessional terms. Okay, but at the end of the day, we are paying back. That's what counts. So we are saying assets minus liability. Okay, so when we look at that, this is the most common way in which the accounting equation is presented. Okay, it can be seen that the two sides of the equation will have the same what? Total. So the term two sides will have the same total. This is because we are dealing with a what? With the same thing from the two different points of view: the value of the owner's investment in the business and the value of what is owned by the owner. Okay. Now that should be very, very clear to start with, so that other things are not complicated. So you are the financial accountant. You need to be able to understand that as the basis for you to be able to understand certain things that are coming later. Okay. Now, unfortunately, with this form of accounting equation, we can no longer see at a glance what value is represented by the resources in the business. Okay. Now, you can see this more clearly if you switch assets and the capital around to produce alternative form of accounting equation. So let's look at this. So let's try to switch it. Okay, let's try to switch it now. We are This liability was a minus, right? So in mathematics, when a variable shifts or crosses the equal to sign, it changes the sign. Okay, so if we look at this liability is a negative. Now, liability, we are making the asset the subject. We find the total value of the assets, so it will come to the other side and it will be plus. Okay, so it is capital plus liability. So that's how you find the total assets. So capital plus what? liability. Now, this can be then replaced with words describing the resources of the business. Okay. Now, resources, for instance, if we go further, we are saying resources, what they are. So, resources, we're talking about assets, what, right? This is resources. Okay. Then, the other side of the resources, we are saying who supplied them. Okay. Now, who supplied these resources? There is what we call capital plus liability. Now, the capital comes your owner, then liability comes the people who assisted you. Now, no matter how you present the accounting equation, the totals of the both each other, and that this will always be true, no matter how many transactions there may be. Okay, so you understand that the transactions, it's either they are part of assets or part of what? Liability. Okay, meaning that you as a business, you are either giving back to the people that gave you money, or you are giving back to what? To the capital. Okay. Now understand further. I'm sure you can have issues right now to understand. However, I ask that you research more and you follow through so that you're able to understand everything as we go on. Okay, as we do other topics, these things will become very, very clear. Now, the actual assets, capital, and liability may change, right? But the total of assets will always equal the total of capital plus liability. Now, I'm saying the actual assets, capital, and liability may change, but the total of the assets will always equal the total of capital and liability. Okay, why? Because capital is what provided by by the owner of the business. Then liability, other people come on board, so these people raise the capital together. Now, as they raise the capital together, they are supposed to be given back what the business produces, okay, in form of profit. Okay, now, in other words, we are saying the more common form of accounting equation, the capital always equal the assets of the business minus the liability. Therefore, that is the standard formula. The formula doesn't change. So now the formula creates a basis for you to be able to find more answers to your questions, and to be able to solve any mathematical solutions that you may need in the future. Okay, now, okay, if that is clear now, uh, what is an asset? Okay, assets consist of so many things, okay, in terms of what the business has. However, we are saying the basic understanding is that assets consist of property of all kinds, such as buildings, machinery, stocks of goods, okay, stocks of goods, and motor vehicles, among others. Okay, other assets includes debts owed by customers and the amount of money in the organization's bank account. Okay, so assets are not only things that you may. They are not only in terms of property. They are also in terms of money and the value that the business has. Assets also can be goodwill. Okay, the reputation that your company has, the business has, that is also asset. It is also an asset. Okay, now, liabilities includes amount owed by the business for goods and services supplied to the business, and for expenses incurred by the business that have not yet been paid for. Okay, they also include funds borrowed by the business. Okay, now, a liability, it is anything that you as a business you have to pay for. Okay, the amount you borrow, then you have to pay back. Okay, now, capital, whereas capital is often called the owner's equity or net worth. Okay, net worth, we are talking about something minus everything. Okay, minus all your liability. How much do you have? Now, it comprises the funds invested in the business by the owner, plus any profit returned for use in the business, less any share of profit paid out of the business to the owner. Okay, so capital, we are saying it is something that the business has as the backbone. Okay, now we are saying it comprises of funds invested in the business by the owner, plus any profit returned. So now, meaning that Any profit that has been retained, meaning when you pay off all the workers, all the salaries, that profit will add up to the capital. Now, that is at the end of the day that you will see. That's why you see that other businesses are able to grow. Why? Because the margin to which the profit is retained to the business is huge, or is bigger. Okay, and as a result, the capital increases, and as the capital increases, the asset increases. As the asset increases, the company grows because the company is able to employ even more people. Okay. Now, if that is clear, thank you so much for attending this lecture on bookkeeping. We'll begin the next lecture looking at the balance sheet. See you in our next lecture. Goodbye.